welcome back. Today I want to talk about how we measure financial health. First of all, what do we mean by financial health? What we actually mean is whether the current level of debt is sustainable in the long term. So that suggests that we try to forecast whether a company can sustain the debt level it carries in the very long term. Now, this by default will depend on profitability levels, it will depend on reinvestment need to maintain growth, and it also depends, of course, on interest rates. So how can we try to quantify sustainability? How can we adopt a framework that can be used to predict default? Now, this is honestly quite a challenging process, and there have been lots of attempts going way back to the so-called Altman Z-scores, where you use various ratios to assess whether a firm has high or low financial risk. The problem is, empirically, none of these ratios is massively convincing. So there is no perfect way based on financials to assess the sustainability of the level of debt. So what are the best things we can get? So number one, ideally, we have market-based measures. So the best measure I like to use are credit default swaps, CDS. Now CDS are only available for very few large corporations, but they enable us to measure default risk more directly. This is basically how the market views default risk. Credit ratings are an alternative. However, ratings tend to be of lower quality, to be honest. There is also lots of empirical evidence of herd behavior where rating agencies follow each other, and there is a tendency that ratings lag behind the development on markets. So that limits, I would say, the insights you can obtain from ratings. In terms of financial modeling, so when we do our discounted cash flow models, we use debt to balance the balance sheet, basically. Yeah, so if a company has high growth rates and maybe also high reinvestment needs, we might need to increase the level of debt. The main issue there is how quickly is debt going up compared to equity. Yeah. So, and of course equity, as we know, depends on retained earnings, so we have to have a sufficient level of profitability. So obviously, if our model predicts a long-term increase in the level of debt compared to equity, so financial leverage goes up, this is unlikely to be sustainable. Yeah, so that would be definitely a concern. And the main challenge appears when it comes to the investigation of SMEs. So for smaller companies, I don't have the amount of information, I don't have ratings, I don't have corporate bonds that are issued, so I can't easily observe on the market what the market thinks about the sustainability of a business. Yeah, it's much more difficult. Nowadays, you use machine learning tools that try to pull together different pieces of information to make predictions regarding the likelihood of default in the case of SMEs. Another important element is if a company is severely restrained in terms of access to credit. So put differently, a company does not have any access to finance. So by default, this company doesn't have any debt. So when you look at this company and looking at measures like financial leverage, well, financial leverage is zero, it doesn't have any debt. So it looks very solid on paper, but it doesn't mean anything. Yeah, because severe restrictions to finance could result in very good ratios. But it doesn't mean that this is a good business. They simply don't get any loans whatsoever. So that's an important point to note. I in fact wrote a paper about these alternative measures which can be used to actually assess financial exclusion. So if you want to explore this further, I recommend have a look at this paper on measuring financial exclusion of firms. So this paper starts with a different premise where we talk about growth potential, and then uses that to assess whether a company is financially constrained or not. However, empirically, so if you want to apply these methods, they are not that straightforward to apply because they do require a fair amount of information on production technology, which is not easily available. So what do we usually do in assessing financial sustainability? So we focus definitely on some core ratios, and of course we are aware that these ratios are not perfect. Our main focus is on financial leverage, but of course there are limitations to that. We already spoke about off-balance sheet items, including operating leases that of course have to be adjusted for. So the level of debt might be a lot higher than reported. Then we look at interest coverage. Now interest coverage is more a short-term measure. So interest coverage is defined as earnings before interest and taxes divided by the interest expense. Now that means can I cover, based on my current earnings, the interest expense? Now you would like to have a ratio of usually around 4 or higher to be sure that even if there is a downturn in the market, you're still able to pay interest. Because end of the day, if you don't have sufficient earnings and you can't pay your interest, you have to get the money from elsewhere. Yeah, so then you can either think about some additional asset sales or equity issues, which usually take a lot of time to fulfill your interest payments, which is not a good sign. And the idea behind this short-term measure, the interest coverage, is that the main risk factor is liquidity default. Yeah, so that's the main issue in practice. In solvency, so if liabilities exceed your assets, so basically you have negative equity, is less common. So in most cases, companies go into default because they can't pay the interest, yeah, and they run into trouble because they're simply running out of cash, but they might be actually solvent. So you might be able to recover, in this case, loans by selling off assets, of course, when you have significant transaction costs. So in the next part, we will focus mainly on interest coverage as a guiding principle to decide about the optimal capital structure that would still allow us to be sustainable. I see you in the next part.